Hi, everyone. I'm Francine, Lacqua, and we're delighted. Good afternoon and good morning to you. We're delighted that you're joining us for this next conversation, Getting to Net Zero, Mobilizing Capital. And I could not be more delighted than to be joined by our two panelists, Matt Christensen, Managing Director, Global Head Sustainable and Impact Investing at Allianz Global Investors, and Herve Duteil, he's Chief Sustainability Officer, America's BNP Paribas. So, gentlemen, thank you both for joining us. Of course, finance, we know, is a very critical part or enabler for solving some of these climate change issues, but also how to speed up the transition to low carbon emissions. What's the best way, we're in 2021, July 2021, to align policy and private capital, Matt?
I'd say if we take this sort of short-term window of the 12 months ahead, we're still working through the SFDR regulation, those of us in Europe, so I'm not going to bother those of you outside the European zone. But what I can tell you is that this regulatory push, which is really about how to mainstream net zero ways of thinking around climate, I'd like to think that in 12 months' time, that regulatory push will have helped us to do a better job of getting data sources that we can use with a bit more of a robust confidence in how they could be tapped in around, for example, a warming temperature, which I think we really need to get towards over time for a net zero perspective. And the other part would be around mobilizing more capital, both from, let's say, private investors and public investors, and how we can think about that there's really need to work together, whether it be developing economies or the emerging economies. And that this 12-month cycle to me is, we're trying to make this push that's moving from a linear to more exponential basis, but we need some more confidence to be able to get off the sidelines and do more.
How much progress do you see actually in the next 12 months? We're hopefully out of COVID-19. So is this really the time to accelerate this?
The time frame of the next 12 months is short, but unfortunately, we don't have much time left to make the right decisions. And I would say three things come to mind. The first one is for those who haven't to take a net zero commitment. We already have a critical mass of financial institutions, which I think are going to be a catalyst for change. So for those, especially in the corporate world, who haven't made a net zero commitment, it's really to wake up that this is what is required now. So I think that's the first thing. The second, I know there's a lot of talk about this, but we really need to shift from voluntary to mandatory disclosures, and I would say quickly. Maybe that's the key word. We know the rest is happening, but we don't have time to get it perfect. So we cannot spend 3 to 5 years trying to figure out what it should be. We need it now, even as imperfect as it can be.
But Herve, how likely is it that actually this becomes mandatory?
Oh, it is likely. I mean, it is more than likely. In the US, as you know, the SEC has launched a consultation on this, and they've made it very, very clear that that they will move on this. Certainly with proposed rulings, and then may take some more time in terms of to work with the standard setters for the details. But we're definitely moving to mandatory disclosure. What is key is that it gets overall aligned internationally quickly, and secondly, that again, that we agree on some core metrics. I don't think it can remain qualitative. There are some basic metrics. I would launch, I would say, scope 3 measures in particular, as crude as there can be. But this would be the impetus for change, and we don't have 5 years to figure out what a scope 3 metric should be.
Matt, do you think it'll be mandatory?
Yeah, on that point, I think the good news is that in spite of the sort of sclerotic way that, let's just take the US, the way that can bounce back and forth, and you have the federal, the state, and we also know how much it can go between a on-off culture on climate change in terms of the regulatory environment. I do think that the EU's position on having played the role of the activist regulator, I think we can say that that's what they're trying to do to influence the shaping of this topic around the world, that we do have a chance that the US And if we take just sort of the 3 years, so I'm moving past the 12-month cycle, Francine, forgive me, but that they have a chance to actually mainstream this in a way that might make it, and also just the timing of other influences happening in the United States, into an environment that is more palatable than it was in the past. And I think that the similar type of things and discussions are happening in Japan and other parts, even in other parts of Asia. So will it happen? I think that forms of the mandatory approach will start to play themselves out over the next 3 years. And I think the voluntary pieces of others following the EU approach, I believe that that's starting to happen already.
But
and
Matt,
if I may add something,
go ahead,
Francine, on that point is investors, you can see over the last 2-3 years, in the proxy battles in particular that investors are launching, that there is a whole slate of topics and issues way beyond financial materiality that do matter to investors. And I think the regulatory agencies that cater to securities and provide getting the information that investors need recognize through, especially the recent wins as well, that investors do pay attention to much more than financial materiality, from climate change to emissions to diversity, equity and inclusion issues.
So I just want to remind everyone watching and listening that you can also write questions. So please don't be shy at all. Just write as many questions as you want, and I'll make sure that our two wonderful panelists will answer them. Matt, if we just take stock of how much, private capital has been able to be mobilized so far, and if you look at the target of net zero, is it working? What's working, and what can we actually do better, Matt?
So is it working? I think all of us would probably say it's not enough, right? So the idea that, in terms of the IEA report, right, it was about the need to go from, say, 150 billion to 1 trillion by 2030 over time. So these are big numbers, but the point is, it's not working enough, but it has started. And I think that that's the good news. Part of what needs to happen is this alignment. I think that's where the standard setting gets a bit in there as well as this alignment of the goals that we might have around the data to more of a temperature and not just emissions. And so everybody spoke about scope 3. This is a part of the whole picture that's a bit missing right now to influence the entire shape of the sector in terms of the way we think about net zero and how we invest. I'd say some areas of what's working are starting to gain traction. More companies aligning to the SBTE, that is the Science-Based Targets initiative. I think that those standards are at least helpful as a starting point for a discussion if we think about investor engagement that we might do with companies around how are they positioning towards a net zero, and that would be one proxy to see what they're doing. But I would say that if we think about where we are today and let's say the Paris standards, if I just use one example, I know that I've looked at the sort of property sector and that the highest building standards that we have at the moment still align around a +3 degree scenario, right? So this is sort of the information that we have today. And when you think about where we need to go, no, it's not working enough, but it's a start. And that's why it is a bit of this J curve that we have to enter now.
Herve, so do you also believe it's slow? I mean, a lot of people will say, look, there's progress, but it's at glacial pace. And how does it get accelerated?
Yes, in a way. But the way I look at it is, first of all, we've come a long way. When I started on this over 7.5 years ago, we were nowhere. No one was looking at it. No one was talking about it. And I truly believe that if sustainability and ESG is on everyone's radars, from CNN to CNBC to the supermarket nowadays.
Bloomberg.
Of course, Bloomberg. But I didn't want to put you as a newcomer to the field, so that's why I didn't name you. I think finance is really responsible for it. We've mainstreamed it before. Sustainable SRI did exist for a long time, but that was niche. What investment banking has done over the last 7 years is to mainstream this, and now it's a topic of conversation. administrations, regulatory bodies, and so on. So we've really come a long way. Now, the second thing is you have humongous investor interest. And that also has grown tremendously from the niche investors, the impact investors, the responsible investors, to now the passive investors even have want to tilt their passive investment to include ESG. So you have huge money is waiting on the sidelines. Now, what's not working is it's all new. And financing Fortune 500 companies to do better ESG, that's easy. We've developed the tools. But in emerging markets, the problems to be solved are complicated. We work on blended capital solutions and so on, but that is slow. We haven't found ways to replicate quickly. And yes, it will take the time it will take.
I don't know whether you want to jump in, and then I have a lot of audience questions.
I just want to say something that what Herve mentioned made me think about this idea of the change and the rapid pace. So the mobilization of capital, let's say we need the J-curve effect from where we are today, but on Herve's point about the attention it's receiving in the media and around many stakeholders, I'd say one of the interesting things that's happened over the last 18 months is the conversation has shifted a bit from what it used to be in this topic. Let's take the wider topic, which is, can you make money doing it? That was a lot of the topic. It's still out there, but it was really a primary question that you would receive, which was, let's look at the returns and risk return profile, et cetera. The conversation has now moved on to, well, and this goes back to the point about passive capital that Herve mentioned, which is, do you have any proof it actually does anything? And that's a newer conversation, which is more about everyone's saying they're doing net zero or they're doing new ways of investing, but what's the proof point that something changed? I'd say that's actually a healthy dialogue that we're moving towards, which is more about a let's accept that we can do this and put this into the capitalist system and make money doing it, but let's now monitor and make sure it makes a difference.
But Matt, to that, so I'm getting a lot of questions actually on reporting and disclosure. So, I mean, what kind of standardized disclosure requirements for public and private companies do we need, and how much progress has the G20 done?
So I'll kick that one off. I think that on the reporting, the challenge has been, if you think about financial reporting, have what, 50 to 100 years over time of arriving at points of agreement, which is reporting that might be good enough. Risk, what's risk, or standard deviation ideas, volatility. You know, these are agreed norms. We don't have the same agreed norms, and we don't have the time. That's something that I think was mentioned by Herve earlier, and I agree with that one, is we do need to get to enough of a norming to agree to move forward. And so the areas on reporting that I would see that become more mainstream, the fastest one is going to be on your carbon disclosure, some sort of form of a footprint, the intensity of your exposure to carbon as one proxy for climate change. Not perfect, but available. The one that I think will be a complement is the one I mentioned earlier, which is not as mature, about how do we get this idea of a temperature gauge, so that if we just think about a person who is looking at the return risk profile and impact profile of their investment strategy, that they could see at a fund basis, what is the warming temperature of their portfolio, or if we just take an institutional investor, that they could see the warming temperature of their aggregated assets across asset classes and be able to say, are they currently at a 3-degree scenario? And are they able to show over time they're moving from a 3 to a 2 degree to a 1.5 degree? That is still immature. But to those questions about reporting and disclosure, that's, I believe, about where we need to move to create more of a standardization and common understanding about what to look at.
How fast do you think we need to get there?
Again, look, we have to be net zero by 2050, which means we need to have everything set by 2030, which means we need to make the decisions in the next 5 years. So we have less than, I think the 3 year time frame that was mentioned by Matt is more or less the right one. I just wanted to add, it will kind of answer that question to an example. I know a very well-known pension fund, and I was very impressed by what they told me a few years ago. They asked all their portfolio managers, they gave them a strong incentive to reduce carbon footprint by 25% in their portfolio. And they took one single metric from one single provider, and they decided to stick to it, not argue, not do an average. They know it's not correct, but they say it doesn't matter. We just pick a standard, and we're measuring the entire portfolio against that standard, and on a relative basis, if you wish, it will put us more or less in the direction we want to be. And this was to illustrate the fact that we don't have the time to be perfect. And the point is not to be perfect. The point is just to get a benchmark that we then get a clear direction and targets from there.
I was looking at some numbers, Matt, and I think, I read that we need a 5-fold increase in extra net zero investments if we're going to shift and actually reach some of the targets. Again, where is that coming from, and how then do those investments translate into the real economy? I mean, at the end of the day, it's about building bridges and transport and industry that is going to be greener.
So I'd say that if we think about the types of asset classes to get there, we do need to see that this is across the entire chain. And so I would think about alternatives, and you mentioned bridges and roads. So one of the things that we've been doing a lot of work on just internally, and I think this is the kind of stuff that's happening across the field, is how to embed more of this way of thinking into the actual preset of information that we're doing through a due diligence, but also with this notion of having some targets about where we want to get to over time. I think that target setting, whether it be the 20% reduction that was a pension fund example, or the fact that I think the profession of asset management right now is looking at how to start embedding target setting across the base of third-party assets over time. We're not there yet, but we're in the middle of those conversations. And what you can expect to see is, if I just give a few examples, you'll see that infrastructure, debt investing is going to include a lot more around how to measure net zero in the forms of investment towards looking at, is an investment going to also shift over time away from, let's say, traditional areas. We just highlighted, maybe you saw this last week, that we have no more investments in coal. So that's an example of what's going away from the set of investments that would be considered more on the dirtier side. But also it's about this emerging market idea that you guys were mentioning, and the idea of public-private partnerships. So we have indeed a blended finance whole area that we're putting together. And one of the strategies that we've launched is a Paris-aligned strategy. And we're looking at how to best measure that with donor capital complemented with private investor capital. And that's the kind of product innovation we also need. We need innovation that's going to be in alternatives, but we also need it between private market and public market. So there's a lot of innovation, Francine, that we're going to need to see happening around anything from the classic green bonds as a starting point to SDG-linked bonds to then things around alternatives. I believe that's what you'll start to see the next 3 to 5 years.
I'm getting quite a lot of questions actually on KPIs, and then you can also go back to a little bit of what Matt was saying. But what kind of key performance indicators are people looking at to really improve results?
So that's in the mainstream, in mainstream finance, I would say, and the KPIs are primarily, well, there's a big variety of KPIs, but of course for carbon-intensive sectors, environmental KPIs, which are linked to greenhouse gas emission, whether in absolute terms or in intensity terms, are the core basis. Then it gets tailored sector by sector. If it's in the cement space, you're going to look at the clinker factor. If it's in the mining space or power utilities, you may look at water intensity and so on. You also have social KPIs, of course, but one needs to make sure that for environmentally sensitive sectors, the social doesn't hide what needs to be achieved on the net zero target. What I wanted to add to the previous topic was that capital is there, and and will increasingly be there. First of all, if you look at the level of oversubscription in green bonds and actually the pricing, so-called greenium that you get because of this higher demand, shows that there is capital just awaiting to get invested. The second and last thing I wanted to add is that why capital is going to be increasingly there. It's because the last 7 years we've really focused on the opportunity side of sustainability and ESG, because we were starting the topic and we of course focused on the best in class and showed them that if you were best in class in ESG, you had greater opportunities. But I think what is becoming really apparent to all, and it's going to be increasingly so over the next 10 years, is that in fact the transition risk is real. And it is a real threat for any incumbent in carbon-intensive sectors, as well as dependents of those carbon-intensive sectors. And so capital will increasingly chase best-in-class and green assets, because they will realize that those who are not transitioning represent an increasingly risk of becoming stranded assets someday.
Okay, on KPIs, and then I have many questions from the audience, which we'll have to whiz through. So the question on KPIs was, what would you be looking at?
Yeah, on the KPIs, I think what we want is to start with the basics as a standard for the entire market. And so I've mentioned the idea of some sort of carbon disclosure, a climate type of KPI that would measure intensity, and then the idea of this temperature gauge. I think from there, we're quickly going to go, and everybody mentioned a bit at sector level. So you'll start to get different KPIs depending on the sector. But I'll give you some examples of what I think will become the next area of research for KPIs that might go across many sectors. Biodiversity is going to be a huge topic. It's certainly going to be coming up at the COP26 in Glasgow as one of the key next areas of, call that the next wave of climate change, will be biodiversity. And there are now initiatives about how to establish what could be a KPI that would do a better job of assessing those kind of natural capital risks or even water risks. So you're going to start to see KPIs developed around waste, water, biodiversity. And I do think that this idea of the social impact cannot be neglected, because it's very easy all of a sudden to really chase the idea of net zero, which can be in a way one that is agreed upon as a planetary need to go after, but that the idea of social risks that are caught up in that are not measured appropriately or not tackled because they're political risks as well as social. I think we have to keep in mind that that's going to be a piece that will cause some controversy as we go forward, which is that it's not just to do environmentally led KPIs, it's how do you ensure that there's a social underpinning to it at the same time.
I'm getting a lot of questions on greenwashing. So there's a growing concern around greenwashing in the financial sector. How are you both addressing this risk, Herve?
So the KPIs can be key, actually. One way to address, I totally agree with you. It's more than a risk, quite honestly, because, and the reason is how fast we've evolved over the last 12 months. Now everyone wants to do sustainable finance, and obviously, if you can, it has to be with high ambitions. So one way is actually to standardize KPIs. Of course, you lower the level of ambitions, but at least you establish a minimum standards, sector by sector, saying, if you're in the steel industry, you should put three to five KPIs out of this list of 15, let's say, or if you're an agri trader and so on. So standardization of the KPIs might be a way to tackle this. Of course, it's a bit deceiving because you can have a minimum standard, but then borrowers will have an opportunity to differentiate themselves by moving from those standard KPIs by adding more ambitious ones or more diversified ones.
Matt, very quickly, final thoughts on greenwashing. How do we avoid it?
I think that what you will see over time, and that the investors and clients will demand, is that when you have a KPI, it will be about, okay, what does it mean? And how do we measure it against what would be a benchmark of some sort. So in the same way we do benchmarking on financial performance, we will eventually get to a better playing field on this measurement of a KPI against benchmark, which is still also not mature, but a starting point so that the base of clients can get a better sense of what was different across peers when they think about climate net zero. So it's not just a standard KPI with no reference point.